So there are adjustments that we make. There are adjustments that we make on the trial balance figures and the ones that we are referring as the end year adjustments. You'll find that in a business organization, we have got what we call the financial years. This is financial year 1, we have financial year 2, and so on and so forth. So when we are referring to the financial year 1, remember it started here. This is the start of the year. This is the end of the year. When we are preparing the financial statements, also what we call the income statement, we are supposed to record the incomes and expenses for that year. Incomes and expenses for that year. And the incomes and expenses here will mean whether it was received or not, it should be captured in that particular financial year. So from the start to the end, what is the income that we generated? Whether we have received the entire income or not, that income must be captured here. What are the expenses that we incurred in that financial year in the process of generating the income? Still, we need to capture it here. Then we can compare, and then we get either the profit or loss. So it is very, very much going to happen that some of the expenses and incomes that were supposed to be incurred or received in year 1, you'll find that the payment spills over to the next period. Maybe it was salary, you are supposed to pay in year 1, part of those salaries have been paid at the beginning of year 2. We can still have a scenario whereby some of the income that you are supposed to receive here, by the end of the year, it has not been received. The income is going to be received here. Another case is whereby an expense that was incurred in year 1, the money was received in excess. We paid, for example, insurance, and we paid excess. Year 1, maybe we were supposed to pay 10,000, but at the end of year 1, we have paid 12,000. The 2,000 that we have overpaid will be utilized in the financial year 2. That is what we call the prepayment. So the end year adjustments, they are going to rotate around the following 4 cases. The case number 1, it is when we talk about accruals. Accruals. This is a case whereby the amount of money is either outstanding or owing, or we also call it arrears, or it is due. It is also unpaid. All those terminologies within the same day. So an expense that is accrued, it simply means that it is outstanding, it is owing, it is in arrears, it is due, or it is unpaid. So when these terms are used, you just know that they mean the same thing. So these are cases whereby either the revenue, by the end of the financial year, when we are coming to the end here, maybe it is the 1st of December. By the time we are coming to this end, some revenue has not been received or some expenses have not been paid. They occurred here. This is where they occurred. Maybe it is the salary for December, year 1. By the end of year 1, that salary has not been paid, but it is paid in year 2. That salary that is unpaid by the end of the year is said to be outstanding, accrued, owing, in arrears, due, or unpaid. And then what we do with it? Then, if it is an accrued income, that one you take it as an asset. If it is an accrued expense, that is a liability. That is a liability. If it is accrued income is income that we have earned, but it has not been received. Income earned, but not yet received, it is an asset to you because it is your money. Accrued expense, it is an expense that we have not paid at the end of the year. So we owe somebody a certain amount of money as an accrued expense. That one becomes a what? A liability. So an asset is when it is an accrued income, not yet received. Accrued liability or accrued expense, it is a liability. That is what you need to know. And then either it is an asset or liability, this money you normally add to the amount of money that you have in the trial balance. That is to say, for example, you will be given the trial balance balances, you have the debit, you have the credit. Maybe you are given the following. You are given wages. This is an expense debited, maybe it is 10,000. You are given insurance. It is an expense of 8,000. You are given rent income. Maybe it is 15,000. Incomes are normally credited. You are given maybe commission receipt. Maybe 9,000 like that. Once you have your trial balance, below the trial balance will be given what we call additional information. You'll be given additional information. Sometimes we can refer to them as the notes. Then they will tell you, number one, accrued wages as at 31st of December 2020 was 1,000. Accrued wages was 1,000. So what do you do with this 1,000? This 1,000 is accrued wage, and the wages are expected. So accrued, that 1,000, we shall take it as a liability in the balance sheet. And then, for us to be able to know the amount of wages that we should take to the income statement, what we shall do, we shall take the amount of what we have in the trial balance is what was already received or what was paid. For the expenses is what we have already paid. We had paid 10,000. We have a balance of 1,000 that we are yet to pay, meaning that the wages were supposed to be how much? 11,000. The wages were supposed to be 11,000. So this 1,000 you add to what you have in the trial balance to get the amount that was supposed to be payable when it is approved. And then the 1,000 not yet paid, becomes a liability. It's going to be a liability in the balance sheet. So 11,000 is what we are going to capture as wages expense. 1,000 when we shall be listing the assets, capital, and liabilities. This 1,000 will fall under the liabilities. So another case now, maybe you can be given another additional information. Additional information number two, whereby you are told accrued. Let me use the other term. Insurance due was maybe 500. Insurance due. This is still the same as accrued. What you do, the insurance that was paid was 8,000 for the insurance. What we are going to capture in the income statement as insurance expense will be the amount that was paid, which is 8,000. You add the 500 not yet paid, we shall consider 8,500 as the insurance expense. We shall consider 8,500 as the insurance expense. And then this 500 will be a liability because it is the money that we are yet to pay. It is going to be a liability to us. So that is what we call the accrued income. The accrued expenses, sorry. So another scenario now, it is where we have what we call what? The accrued income. This is income that is not yet received by the end of the financial year. A good example is the rent income. If you are yet to receive any rent and the year has come to an end, that rent is an asset to you. It is money that the business is supposed to demand. It is an asset to the business. And then the same scenario will happen. We shall add that rent that is approved to the rent that is already received so that we can be able to determine the total amount of rent receivable in that financial year. So if, for example, number 3, we have what we call what? Accrued rent income was 2,000. So what do you do with this 2,000? You just go to the rent income, we receive is 15,000. So you take 15,000, you add 2,000. So the total rent that you are supposed to receive is 17,000. So at the end of the day, you need to realize that when it comes to accrual, whether it is an income or it is an expense that is accrued, what you need to do here, you need to add the accrued amount to get the total amount of revenue or the total amount of expense that was supposed to be incurred in that financial year. And then you ask yourself, was this accrued amount an income or accrued amount as an expense. If it was an expense, you take it as what? You take it as a liability. If it is an accrued income, you take it as an asset in the statement of financial position. In the statement of financial position. So that is it. That is it. Then we have another ND adjustment we call repayments. There is another ND adjustment for yes, Esther.
Excuse me. Okay, I didn't understand of the accrued income.
Yes.
So when you say the accrued income was 2,000,
yes.
and in the balance sheet you are given 10,000. So the 2,000 you're supposed to take it as an asset in which one? In the balance sheet.
The balance sheet.
And the 15,000.
Okay, sorry. Go on. Go on.
I'm asking. So the 2,000 is in the balance sheet, and the other one in the income statement.
No,
or how do
two statements that we shall be preparing. There's one we call the income statement. This is the statement that we normally use to determine the amount of profit or loss the business generated in a year, in a period. So here,
okay,
we consider the total revenues minus the total expenses or costs. Let me just say that. When we are preparing the income statement, we normally consider all the incomes, all the expenses. So in the income statement, if for example the trial balance we had 50,000 as the rent income, and then the additional information tells you that there was accrued rent income of 2,000, so you add the two of them to get what? 17,000. This is now the total revenue from that particular source of revenue, which is rent.
okay.
Now, another statement we call the balance sheet. In most cases, you find it to be known as the statement of financial position. In this statement, we normally consider the following items: assets, the capital, and liabilities. So when you will be listing your current assets in this statement, this amount of 2,000 that is still not yet received, it is going to be there. You come here and say accrued rent income 2,000. So the 2,000 here, sorry, the 2,000 here, it is going to be a current asset. The amount not yet received is an asset. But the 2,000 will be added here to get the total income or total revenue for rent. Are we together?
Yes, I understood now. Thank you.
Okay. Okay. That is on the accruals. So adjustment number one is talking about the accruals. Number two is about the prepayment. The prepayments, they occur when you have overpaid a certain amount or you have received more than what you had received. So it occurs when you pay excess or you receive excess. Like for example, if you pay more of your school fees than what was supposed to be paid in that particular semester, so you have done what you call a prepayment. So actually, the person who has paid is like he's going to demand a refund. So under the prepayment also, we are going to have the prepaid expenses. When we talk about a prepaid expense, it is an expense that we have paid more than what we were supposed to pay. Like for example, if the insurance we pay maybe 18,000, but the actual amount that was supposed to be paid was supposed to be 15,000. We have paid 18,000, but we were supposed to pay 15,000. So we are going to have a prepaid. We are going to have prepaid insurance, which is going to be equal to 3,000. The 3,000 will be going to be prepaid. At the same time, you can have what we call prepaid income. Prepaid income, like for example, commission received is 12,000. We received commission of 12,000, but in the actual sense, we were supposed only to receive maybe 11,000. We have received 12,000, but we were supposed to receive 11,000. So there, we are going to have a prepaid commission receivable of 1,000. Prepaid commission receivable will be 1,000. It is going to be 1,000. So this insurance amount that was prepaid, because remember it is our business that paid insurance, but we paid excess. This excess that we paid, it is going to be a current asset. It's going to be a current asset. For the commission received, this 1,000 that we received in excess, it is going to be a liability, because we received more than what we were supposed to receive. So actually, we are supposed to refund this 1,000 to the person from whom the money was received. So we owe the person 1,000. It is a liability from our end. This is an asset because we are the ones who paid excess. So we need to be refunded our money. So it is an asset to the business. But how now? What is the amount that you are going to treat as a revenue or an expense? So the amount, remember we paid 18,000, but 3,000 was excess. In the income statement, what we are going to capture as insurance prepaid or the insurance expense, we shall take 18,000, we minus the excess of 3,000, we shall capture 15,000. We shall capture the actual amount that was payable that year. For the commission receivable, we shall do the same. How much did we receive? We received 12,000, but 1,000 was excess, so we record the actual amount which is what? 11,000. So when it comes to the prepayments, we normally deduct the prepaid amount. For the accruals, we say we add. For the prepayment, we rest or deduct the prepaid amount. So that now you can be able to get the correct amount that was supposed to be paid or received. That is very important. So that is the NDR adjustment number 2 that we are going to come across. Another NDR adjustment, which is now number 3, it is about depreciation. Depreciation, we know it is the loss in value of an asset. We have got these assets in the past, the fixed assets. The fixed assets are those assets that are going to remain in the business for a long period of time, more than a financial year. The motor vehicles, the buildings, computers, machines, furniture, all those are fixed assets. They are going to be in the business for a long period of time, yes. But as they serve the business, their value diminishes. If you buy a new computer today, it will have a higher value. But as you keep using it, it reduces or loses some value. So at the end of the year, after using it for 12 months, its value cannot be the same as the value at which you bought it. It will have reduced. The process by which the fixed asset reduces or loses their value is what we refer as the depreciation. For examination purpose, you need to understand that we have got two approaches of determining the depreciation amount. One is what we call the straight line. The straight line. Have the straight line method. The straight line method makes an assumption that depreciation per annum of an asset remains constant, or the asset reduces by the same amount every year. The asset reduces its value by the same amount every year. So in year one, it has lost 2,000. Year two, it will also lose 2,000. Year three, 2,000, until the end. So the value by which the asset reduces the amount with is constant. If it is 3,000, it is 3,000 across the years. That is the straight line method. And we have got two approaches by which you can be able to calculate depreciation by straight line. So the depreciation per annum is given by the cost minus the CDU, also known as the salvage, also known as the scrap bar, divided by the number of years. If you are not given this, the residue or the scrap value, if you are not given that, remember this is the value at the end of the economic life of the asset. If I bought a computer, I'm going to use it for 5 years. After 5 years, I can sell it and get some money. That money that I will get at the end of the useful life of the asset is what we call the salvage or the scrap value. I will use my computer for 5 years. I've acquired a computer at 5,000. I will use it for 5 years. After 5 years, I can dispose that computer maybe at 8,000 or 5,000. That 5,000 that I will get after the useful life of that computer in my business is what we call the scrap value. If the scrap value is not given, then depreciation per annum will be simply the cost divided by the number of years. This one is not given. That is not given. So if I have bought a furniture, the cost is 10,000. So the depreciation per annum will be equal to the cost is 10,000 for that furniture. I'm going to use it for 4 years, and then after 4 years, I can be able to dispose it at 2,000. So I'll take 10,000 minus the 2,000 divided by 4, the number of years I will use it in my business. So this one will be 8,000 divided by 4, then it is going to be what? 2,000 per annum. Every year, my furniture will be reducing by what? 2,000. So it is going to be 2,000 per annum. So it is 2,000 year one. Year one, we are going to lose 2,000. Year two, we are going to lose another 2,000. Year three, we are going to lose another 2,000. And then year four, we are going to lose another 2,000. This gives us a total of what? 8,000. The 8,000 has lost. So the 8,000 is this value. So it will have lost 8,000. And then the remaining 2,000 is what we are going to dispose to get it back. So the value. So this 8,000 that is lost, it is going to be distributed equally among the 4 years. Among the 4 years. So this is what we call the straight line method. But in most cases and in most examination scenarios, they will not be giving you this. They will not be giving you that. What they will give you, it is a percentage. It's going to be a percentage. So under straight line, depreciation per annum can be equal to percentage of what? Percentage of cost of the asset. When you are told that the furniture depreciates at the rate of 10% per annum, on cost. When they mention this word on cost, they are simply meaning that we are calculating depreciation on what? Straight line method. When it is a percentage on cost. The cost is the price that you paid to buy that particular asset. If it is worth that furniture, then it means that the furniture is losing 10% per annum times the cost of that asset, the furniture. Remember, we bought the furniture at 10,000. So it is going to lose what? 1,000 every year. 1,000 every year. When it is on cost, I insist that when it is on cost, just know sometimes they might not tell you on cost. Sometimes they can tell you the furniture reduces at 10% per annum on straight line. So there they want to know whether you know that when it is on straight line and it is a percentage, you need to multiply by the cost. So they can give you the two scenarios. They can tell you 10% on cost, or they can tell you 10% on straight line. So whichever the case, you need to multiply by the cost. The method number two, this is method number one. Method number two is what we call reducing, also known as the diminishing. The diminishing balance method. The reducing or the diminishing balance method. In this method, depreciation per annum is not constant. Remember, we have said under the straight line, the depreciation per annum is constant. But under the reducing balance or the diminishing balance method, the depreciation amount keeps reducing from the first year to the last year of the useful life of the asset. So the depreciation per annum is considered, depreciation per annum is given by a percentage times the net book value, NBV, a percentage of the net book value, not the cost. It is now the net book value. The net book value, NBV, you simply take the cost minus accumulated depreciation. You simply take the cost minus accumulated depreciation. For our case here, if we were to do this, remember the cost of this furniture was 10,000. The cost was 10,000. If you were to calculate the depreciation for maybe the first 3 years, the furniture will be used in the business, you will find that the depreciation in year one will be equal to 10% times 10,000. This is the first year, you will get the amount of 1,000. When we go to year two, the depreciation will be 10% times, remember the asset in year one has lost 1,000. The asset has lost 1,000. So the remaining value is what we call net book value. After depreciation, the remaining value. So in year two, we are going to use 10,000 minus 1,000 minus the value already lost. So we shall do 10% of the net book value, where the net book value is the cost minus accumulated depreciation. The depreciation for year one will be minus from the cost so that we can get the remaining value on that furniture. And then that remaining value is what we multiply by 10%. So you find that this one is what? 900. This is 9,000 and 10% is 900. When we go to year three, it is going to be 10% times, remember the cost now it was 10,000 minus the accumulated depreciation will be 1,000 depreciation for year one plus 900 for year two. It has a total of what? 900 as the accumulated depreciation. So this one will be 10,000 minus 1,900, which is the same as 10% of 8,100, which is going to be equal to what? 810. Which will be equal to 810. Like that. We do minus accumulated depreciation. Depreciation, you go add it. So when we go to year four, it is going to be 10% times, it is 10,000. So what is the total depreciation? 1,000 for year one, plus 900 for year two, that is 1,900, plus 810, that one is going to be 2710. So you get the difference, that is the net book value, then you multiply by 10%. So you realize that as you go along, the depreciation amount keeps reducing. Year one it was 1,000, year two minus 2710, you get 7290. So this one is going to be 4729. So the depreciation keep on reducing simply because the value of the asset is also reducing. The value of the asset is also reducing. So you need to be very careful. When it comes to an example, you will be told either to calculate depreciation using straight line or using the reducing balance. If it is straight line, they will tell you it is on cost or on straight line. If it is on reducing balance, they will tell you it is a percentage on reducing balance. If it is on reducing balance, just a minute. Okay, we can go on. So that is it. When you are told it is on straight line, it is straightforward a bit. But when you are told it is reducing balance, then it simply means that they will be giving you the cost and the depreciation. When it is let me come up again. When it is on reducing balance in the question, they will give you the cost of that asset and the accumulated depreciation of that asset. And the accumulated depreciation on that asset. They will give you the two of them. They will tell you furniture, that is in the trial balance, they will tell you it was having a cost of 10,000, and then they will give you provision for depreciation on furniture. They will tell you maybe it is 3,000 in the trial balance. Then they will tell you that depreciation on furniture is calculated as 10% per annum on reducing balance. So you come here and calculate depreciation rate, 10% times, you take the difference between these two, 10,000, which is the cost, minus the depreciation 3,000. So it is going to be 10% times 7,000, which is going to be 700. This is going to be the depreciation. The depreciation amount for each year is going to be treated as an expense. Depreciation amount for each year, we treat it as an expense in that particular financial year. We take it as an expense in that particular financial year. I hope that is clear, unless somebody has a question. Good. So the last end year adjustment that we shall be coming across, it is normally the bad debts and allowance for doubtful debts. Provision for doubtful. Bad debts and provision for doubtful debts. A bad debt, when we are talking about bad debts, these are unrecoverable. The unrecoverable debts. When you are selling goods on credit to your customers, the credit customers will be referred as your debtors, also known as the accounts receivable. Credit customers. So some of these credit customers or debtors, they might never pay you. Those debtors who will never pay you and you have confirmed that they will never pay you because of some prevailing circumstances, then the amount of money they owe the business is going to be treated as bad debts. So bad debts arises as a result of credit sales. And those credit sales results to scenarios whereby the customers have actually gone to a level whereby we have confirmed they will never pay. Either those customers have been declared bankrupt by the court of law. You cannot demand money from any person who has been declared bankrupt by the court. That person is gone. That person is deceased. You cannot keep waiting for that money to be paid, and you know the person is no more. That person went abroad, and you don't know where or when he's going to come back. You don't have his or her contact. It's 3 years down the line. That amount of money should be removed from the books of accounts and it should be considered as bad debts. So those unrecoverable debts, the bad debts are going to be treated as what? Expenses. They are going to be treated as expenses in the books. It is money the business has lost to the debtors and which the business will never recover. So bad debts written off, take them to be expenses in the book. So those unrecoverable debts, we call them or we treat them as what? Expenses. So when we shall be listing the expenses for that year, we shall include those bad debts. And the good thing, the question will provide you, they will just tell you, bad debts, written off. Bad debts, bad debts, written off. Okay. Then, after the bad debts, we have got now what we call allowance or provision. So allowance for it is similar or related to the bad debts. Remember, these are bad debts written off. They have already been considered unrecoverable and they have already been removed from the books of accounts. So the debtors amount we normally reduce by the bad debts written off so that we can be able to get the debtors amount that we can receive by the end of the financial year. For the allowance for doubtful debts, this is an estimate. This is an estimate of what might not be recovered by the end of the year. It's an estimate. It is not exact. You estimate from experience, maybe 5% of the debtors never pay by the end of the financial year. The 5% that might not be covered by the end of the year, we take it or we consider it as a provision. We consider it as a provision. You are going to consider it as a provision, as an allowance. So it is like to caution yourself. Like for example, I made sales. This is credit sales, so I have got the debtors, which is equivalent to how much? Which is equivalent to 150,000. So at the start of the year, I made a provision. I made an estimate that 10% of debtors probably they will never pay. 10% of the debtors will never pay. So what do? You will come here and do 10% of the debtors 150,000, which is equivalent to what? 15,000. That amount you are doubting. That's why it's known as doubting. You are doubting, but you have not confirmed. So what will happen the next year, the following year? The following year, the amount for the debtors comes to what? Maybe 180,000. So the provision will be 10% times 180,000. What you are not going to cover or you are doubting to cover is 18,000. like that. So it is going to be like a sequence. For the first year, this is year 1. This is for year 2. And this is for year 3. When it is year 1, the whole amount, 15,000, you take it as an expense. The first time you are making the provision, the whole provision amount is an expense. Then in the subsequent years, you are going to determine whether the allowance or the provision is an increase or a decrease. That is to say, in year 2, it moved from 15,000, now it went what? 18,000. So there is an increase of what? 3,000 here. Then the expense will be this 3,000. This is the 3,000 will be the expense only, not the whole 18,000. In the subsequent years, you consider either the increase or the decrease. If it is an increase, the increase amount only, you take it as an expense. You take it as an expense. So when we go to year 3, it has moved from 18,000 to 16,000. This is a decrease of 2,000. This decrease, you now take it as an income. If it is a decrease, you take it as an income. Incomes means that you add to the gross or the incomes. We normally add them to the gross profit. Be it rent income, be it discount received, commission received, and others. Anything that you receive and it becomes an income to the business, you add it to the gross profit. When we are preparing the income statement, the moment we arrive at the gross profit, we normally pause. We do a pause and then go back to the question we did. Do we have other incomes the business was generating? If there is, we add that to the gross profit. So among those incomes will be decrease in provision for doubtful debt if it decreases. So you will be given the figure for doubtful debt at the start, and then you will be told to calculate the doubtful debt at the end. Then you determine if the figure at the start was this, and at the end I've calculated it is this. You ask yourself, has it increased or reduced from the figure at the start? If it has reduced, like it has done here, year 2, at the end of year 2, the provision was 18,000. At the end of year 3, it has gone down to 16,000. It has reduced by 2,000. This 2,000 we shall add it to the gross profit. But for year 1, when we made the first provision, you will know that this is the first provision because you will not be given the figure at the start. You will not be given the opening figure for the doubtful debt. They will just give you an information on how to calculate the doubtful debt at the end. So if you don't have a figure to compare with at the start, then you consider that to be a new provision. The first time the provision is made and the entire amount you consider it to be an expense. The entire amount you consider it to be an expense. So that is very important for you to know. Very, very important for you. How to do it? With the bad debt written off, that is straightforward. The figure that you are given in the question, that same figure you take it as an expense, you include in the list of expenses. But on how to deal with the doubtful debt, it can be a new provision, the whole amount you calculate, an expense. If it can lead to a decrease, add it to the gross profit. It can lead to an increase, the increase only. So I think having said that, we can now visit the financial statements of a sole trader and then see how these adjustments are applicable there. Because these adjustments are applicable in the financial statements. You will not be given a question to do the adjustments to calculate this. It is a matter of understanding so that when they appear in the question, you know how to deal with them. What should you add where, what should you subtract from where, and then you are good to go. So it is not going to be a question whereby you are going to calculate the following adjustments. No, these adjustments are going to be included in the questions involving financial statements, whether it is for the sole trader, whether it is for the partnership or the company. These adjustments are necessary there. So, financial statements of a sole trader. Financial statements of a sole trader. A sole trader, it is a form of business organization that is owned and managed by one person. Sole proprietorship. Business organization owned and managed by one person. The same person is the person who will enjoy the entire profit, or it is the same person who will incur the entire loss the business might incur. So the owner is one person. The owner is one person. So these traders, the sole traders, they normally prepare two statements. Number one is what we refer as the income statement. Number two is the statement of financial position. The income statement and the statement of financial position. Those are the statements that you are required to prepare for the sole trader. So you need to understand how do you prepare them. For the income statement, for those who are maybe in a business class sometimes back, this is what we used to call the trading profit and loss account. The trading profit and loss account. In those days, we used to prepare them as a T account. We used to have them as a T account, whereby we have the debit and the credit. Nowadays, we don't call it the trading profit and loss account. It is not an account. The T account is what we call an account. But this now, we normally prepare them in the form of statements. A statement is normally easy for anybody who has not been in the accounting class to actually follow and interpret it. But when you put it in a debit and credit, it is only meant for those people who have been in accounting class. Those are the people who can be able to understand what is debiting and crediting. But for somebody who has not been having an accounting background, it might be challenging to interpret this. So we normally prepare them in statement form. That's why we call them income statement and the statement of financial position, so that somebody can follow. In the statement, we simply say add this, minus this, and all that. So it can be clearly be shown how the net profit was arrived. So the income statement purposely is prepared to determine profit, to measure the performance of the business in terms of profitability. Measure the performance of the business in terms of profitability. How much profit? How do you determine profit? Even if you have not been in a business class, you know how to get the profit. The profit you simply take. For example, it is one item. I have bought this pen maybe at 100. I sell it at 120. I take the selling price, which is 120. I minus the cost, which is 100. I have made a profit of 20. In the business scenario now, you are not going to sell one item. You are going to sell a number of items. So the total items that you sold and the money you generated from there, selling those items will normally consider to be sales. The total amount you generate is what we call the sales. All the items you sold in that period. The statements are normally prepared after 12 months, after the end of our financial year. So the total amount you sold and you received, or you have not received because of the credit sales, both of them combined, cash sales and credit sales, we combine them to get the sales for the period. Then from those sales, we now ask ourselves, those goods that we sold, how much did they cost us? So we're going to come here and you minus what we call what? Cost of sales. Cost of what was sold is what we call cost of sales. So this one will give you what we call gross profit. This one will give you what we call the gross profit. So the gross profit I've told you, you need to come here and add other incomes. Add other incomes to the gross profit, so that you can get here what we call top of income. Top of income. From top of income, now you come here and address what? Come address expenses, so that now you can arrive at what? The net. That is the simplest way of doing it. Sometimes you also remember that it can be lost. You do it in a statement form. Only that, we are going to have many items involved. Expense is not a single item. Expenses are many. Rent paid is an expense, insurance is an expense, electricity, wages and salaries, bad debts, depreciation we said is an expense, so it is a list of items. So you need to list them. So when we talk about cost of sales is a computation. How do you determine the cost of sales? So when you are determining the cost of sales, the cost of sales, what you do, you take, actually we are talking about the cost of what you sold. Yes, you sold the items and generated sales, but what was the cost of what you sold? So that you can compare with the sales amount. The cost of sales will be given by the opening stock. Opening stock or inventory. You add purchases, you minus, remember the purchases here we are talking about net purchases, you minus the gross stock. Net purchases is given by the purchases, you add current inwards, you minus purchases tax, also known as return outwards. That is how you get the net purchases. The total amount it costed you to bring goods to your business. Remember, purchases is when you buy goods. So how much did you spend in buying those goods? It is purchases. This is what you paid the supplier. Purchases is what you paid the supplier. After paying your supplier, you incurred carriage inwards. Carriage inwards is the cost of transporting the purchases. Those goods that you bought, you had to transport them to your business. So the cost of transporting them to your business is what you pass the carriage inwards you add to the purchases amount. And then the purchases returns. These are the goods which you acquired, and then later on you returned back. So in simple terms, they were part of the purchases, but they were returned back to the suppliers. So we need to minus from the purchases so that we can get the amount of the goods that remain in the business waiting to be sold. That is what we call the net purchases. The net purchases cost. To that net purchases, you normally add the opening stock, the cost of opening stock. Remember, a business is like a series of years. An year comes to an end, a new financial year starts. After it starts, it also comes to an end, another one starts. So it is like a cycle. So by the start of the year, we must have inventory. It does not make a sense that when the financial year is coming to an end, we have got zero stock. In practical scenario, that one cannot happen. When the year is coming to an end, yes, it has come to an end, but we have got stock items. Those stock items that we close with this year is what we open with the next day, which is the new financial year. So the stock, and here we are talking about the buying cost of the opening stock plus the net purchases. This is the cost of the additional stock. You minus the cost of what was not sold by the end of the year, which we refer as the closing stock, to get what we call the cost of sales. So I will give you a very brief format of the income statement. For the income statement, this is how we arrange the items that are involved. And don't forget, the income statement, we don't talk about assets, capital, liabilities. We talk about revenues and costs, income and costs. The money that we received, the money that we spent in the process of running the business. So the format here, income statement, format. So we normally start with business name. Then you write there, income statement. For the year, and then You put there, you provided in the question, underline your heading. This is not an account, I told you this is a statement. You just underline there. Maybe it is Mwema Traders. The financial year is coming to an end at 1st December 2018. So you write there, Mwema Traders income statement for the year ended 31st December 2018. You underline. So here you have 3 columns, especially when purchases requires adjustments. The first item should always be the sales. How much sales did we make? We made a figure of that amount. To that figure, you less return inwards. Return inwards is the same as sales returns. You come here and you rest. Sales minus sales returns gives you net sales. The actual amount of sales is the net sales. That is the figure there. Remember, you sold the goods. Sales returns, they are goods that were returned, meaning that they are in sales, but they were returned. In simple terms, those goods were not sold, so that's why we deduct from sales. We sell goods to your customer, the customer returns part of the goods. So how much did you sell? You minus what was returned. Then, from the net sales, you come here and less the cost of sales. The cost of sales comprises now, that is what I told you, the opening inventory, the opening stock, and the purchases. Purchases have got some adjustments to be made on it. So sales goes to the left column, opening stock to the middle column. Purchases when it requires an adjustment. If it does not require adjustment, if in the question you are not given carried inwards or return outwards, purchases should come here. If there is no carried inwards, there is no purchases return. You put it here. But if it has an adjustment, you adjust it in this column first. So we say to the purchases you add carried inwards. Carried inwards. Yeah. Then you rest purchases returns. Purchases returns, return outwards, so that we can be able to get our net purchases. Our net purchases comes there. Our net purchases comes there. So that now opening stock plus the net purchases gives you what we call cost of goods available for sale. Less closing stock. To get the cost of sales, you take it there. So it should be now in the line where you have got your net sales, so that you can compare. This is the sales, this is the cost of what was sold. The difference would be either gross profit or it can also be a loss. That is sales minus cost of sales. Either gross profit. If this one is more than the cost, that is profit. But if the cost is more than the sales, that is a gross loss. Then here you add other incomes. You add, what are the other incomes? One of them is the discount received, rent, income or rent received. You also have commission received. The other one should be decrease in doubtful debts, among others. So you come and add them there. What the business has, the person has provided you so that you can get stock of income. is your total income. From the total income, now you come here and you rest expenses. Come and deduct the expenses. What are the expenses now? The expenses, we know they are very many, but don't forget the depreciation on assets. We also have what we call the bad debts. We also have what we call discount allowed, carried outwards. Remember, carried inwards, added to the purchases, but carried outwards, this is the carried on sales. It is like offering the after sales service. The customer buys goods from your shop and then you offer customers. So it becomes an expense to you. Then we also have the others that we know, the increase in debts. We also have things now like electricity. We also have things like tariffs and revenues. Things like the insurance. Things like the repairs, rent, expense. All those are expenses. So what we do, we come and we put the values here. So that now we can arrive at what the difference between these are the total expenses. Once you have added all of them, you bring the total there. After adding all of them, you bring the total there. This is the total of all these figures. Then now the difference between the total income and total expenses gives you either the net profit or it can be a net loss. That is the end of your income statement. That is the end of your income statement. So understand the flow. The key thing about this statement and maybe what you need to know. In your exams, they must give you one of them. Either they tell you to prepare the financial statement of a sole trader or a partnership or a company.
Excuse me, Marlene.
Sorry?
Excuse me, Marlene.
Yes?
And the income, you
Yes.
said you add other income.
Yes.
Is the decrease of the doubtful debts an income? Because we said it should be treated as an income.
Yes, you said it is treated, should be treated as an income.
So we should add it there at the income.
Yes, you should add it to the gross profit. Decrease, but
Okay.
it is an expense. Increase in doubtful debts, it falls under expenses. But if it is
Okay.
you take it as an income, the decrease only.
Okay.
Started with 18,000, then it reduced to 16,000. The 2,000.
Yes.
So we should add here the 2,000 for that case.
Okay. Thank you.
Then that is the code. In the question in your exam, you must be given one. If it is not a sole trader, you will be given partnership. If it's not in the partnership, you must be given the statements for the company. One of them must come. That is a must. So understand the flow. So you can clearly see in this statement, we don't have things like the motor vehicle, the cash, the debtors or accounts receivable, the creditors. We don't have them here. This statement does not also incorporate capital. Nowhere are you going to see capital here. It is talking about how we generated the revenue and the cost that we incurred in generating that revenue. So it is a statement that is talking about revenue and expenses only. The only thing that can come here probably it is when we are talking about the depreciation of those fixed assets. Like for example, if you have a motor vehicle, obviously it can depreciate. The depreciation amount only is what we bring here. But you will never find the motor vehicle cost here, where furniture, cash at the bank, cash in hand. You will never find the debtors, what the customers owe to your business, the creditors, what you owe the suppliers. Those items you will never find them here. The other thing you need to remember now, we talked about the end year adjustment. Number one is how to determine this depreciation. Number two is how to get this decrease or increase in the debts. Number three is about the accruals and the prepayments. So some of these expenses will be either accrued or prepaid. You need to know how to get the correct figures if there are accruals or prepayments. Then you are done. So I want us to do probably a question for this. I want us to do a small one. That question number one that occurred in June 2023. That question number one, it was in CSR 204, the June 2023 series, talking about the books of Watam traders. We are given the gross profit, commission received, rent received. You can be able to see those. Commission received is an income, rent received is an income. Then there is rent expense, insurance expense, motor vehicle expenses, salaries and wages. Motor vehicle is an asset. So when you are preparing your income statement for motor vehicle, what you take there is the depreciation of the motor vehicle, which is actually captured in additional information number one. And you are told depreciation on the motor vehicles was at 10% per annum using straight line. So it is 10% of the cost of that motor vehicle. Rent outstanding, that one we say is the same as rent accrued, not yet paid. Accrued, not yet paid. And we said all accruals you add the figures. There is rent that is there, that is of 10,000, and there is accrued of 15,000. So you ask yourself, in that year, how much were we to pay as rent? So it is what we paid 10,000 plus what we are yet to pay, 15, to give us a figure of 25. Salaries owing, those are the salaries we are yet to pay. The salaries and wages that we paid, they were 40,000. We still owe our employees that 20,000. So the total amount for salaries that we were supposed to pay that year was 60,000. Insurance prepaid. Prepayment, we said you have paid in excess. So we paid insurance of 40,000. In that 40,000, 25,000 was excess. It will be utilized the next year. So how much was the insurance expense for this year? You take 40,000, you minus 25. Accruals add, prepayment minus. Accruals add, and remember we said accruals comes in the many terminologies. It can be accrued, it can be written as outstanding, it can be written as owing, due, arrears, and paid. All those they simply means accrued, not yet paid. So that amount is supposed to be added to the amount already paid in the balances. So in this question number one, if you can access it from your other gadget, I want us to do it in 10 minutes time. If you look at the question, we are given the gross profit. We are not given about sales, the stocks, that is the opening and closing. We are not given about the purchases. The question has given us the gross profit. It has provided us with the gross. So actually we are supposed to start from there. The gross profit, we are supposed to start from there and prepare this statement downwards. The upper part is what we call the trading. We have already done the trading part. Up to there, we call it the trading. The trading account. They have done the trading. They came up to the point of the gross profit. So we are told now we proceed. So we did gross profit, we know it. We have been given the rent receivable and commission received. We add them. Then we shall get the total income. After getting the total income, we get all the expenses that we are given. One of them is depreciation of the vehicle, plus others that we are given, salaries and wages, we are just insurance and the others. So let us see how that statement will appear. This that we needed to start with the title. Watamu Traders. Income statement. For the year end. We are told for the year ended 31st December 2021. For the year ended 31st December of 2021. That is your heading. So then, because we don't have purchases, it's only the purchases that makes us to have 3 columns, because it might require the adjustment for the carried inwards and the purchases returns. But if purchases does not require adjustment, we don't need 3 columns for amounts. We only need 2. So here we are starting from the gross profit. The gross profit for that year is 1,500,000. Then we come here, we say add other incomes. The other incomes we have is commission received. How much is the commission that was received? No adjustment and the count. There is rent received, we just add rent received. Rent received, it is 50,000. So how much is the total income? 1,050,000. Then you come here and tell me less expenses. So that we don't omit the additional information tax, we start with them. Depreciation on motor vehicle is one of them. 10% should be calculated at 10% using fixed times the cost of the motor vehicle 2 million. You calculate that one will give us 200,000. The other expense there is rent. I'm still handling the additional information so that I can adjust whatever we have. Rent outstanding is 15,000. So you go to the trial balance. How much was the rent that was paid? We paid 10,000. 15,000 is outstanding. So the total rent payable that year was 25,000. That is the rent expense for the year. Additional information number 3 talks about salaries And these salaries are owing. Owing is the same as accrued or outstanding. How much were the salaries and wages? We paid 40,000 in that year. 20,000 is still pending. So the salaries and wages we were supposed to pay was supposed to be 60,000. Insurance prepaid. So the expense insurance requires an adjustment. How much did we pay for insurance? 40,000. But when it is a prepayment, we minus the prepaid amount, the extra amount we paid, which is 25,000. So we were supposed to pay insurance of 15,000 that year. We were supposed to pay 15,000 for insurance that year. Then we have adjusted, then we find out we have other expenses from the balances in the question that are not supposed to be adjusted. So commission received is there, rent received is there, rent has been captured, insurance is captured, motor vehicle expenses is another expense. Motor vehicle expenses. 20,000. Then only that. Remember we said motor vehicle we can't bring it here, we only bring depreciation. So this is a total of how much? $20,000. Total income minus total expenses will give us $1,000,000. That is the net profit for the year. That is the net profit for the year, and that is what the question requires. That is what the question requires. So this is how you handle the ND adjustments. Just understand, is it a prepayment, is it an accrual, is it a depreciation, is it an allowance? So you do them like that. Any question? So I think with that, I want us to stop there. Maybe tomorrow we can finish now on the statement of financial position. So I want you to attempt the second question. Attempt the second question on that document. So the second question in that document, still asking about the income statement. Prepayment is the same as paid in advance. Amount paid in advance is the prepayment. When it is due, it is the same as accrued. So, attempt question number 2. It is actually the same approach. You are starting from the gross profit. You are starting from the gross profit. You calculate the depreciation for those assets. That is motor vehicle, equipment, and furniture. Then you also consider the balances as at the 1st December 2021. Those are the accruals and prepayments. You are done. So try that question number 2. Tomorrow I come and then we do the statement of financial position for a sole trader. That will be the end of that. So we are going to look at more examples. We are going to look at the statement of financial position, and then we are going to do a question comprising of both. Then we shall be good to go. So for today, we stop there. Enjoy your day.
Same too. Thank you.